So let's touch on this. I mean, we saw banks actually pushing the overall market up.
First Rand did very well. Banks are doing well at long last. I mean, I've been banging on this drum for so long that I'm starting to not believe it myself.
First Rand's up 1%, ABSA up 0.7%, Standard Bank up 0.3%. Investec is down though today.
Yeah, but I mean that's relatively small. I don't think it's got anything to do with the deal. I mean, quite frankly, there's no big movement in the market today. There's no one sector that's up 3% or down 4%. There's no actual big movements. I think the market's had a nice little spurt. January, nice little spurt here. I think it's going to just sit tight for a little while now.
Historically, though, when we have a very strong January, it spells bad news for the rest of the year.
Let me tell you the story about the January effect. You'll go and torture the numbers and study everything, and you'll study it and you'll see statistics like 83% of the time the market goes up in January. And that's true and it's factual until the year you want to try and make money out of it. That's the year the market will go down in January. So don't worry too much about the sell in May and go away and the January effect and all of these things.
So we should forget about it, hey?
No, don't worry too much about it.
So we touched on Investec, it's down 0.8%. Irish Securities Group, NCB, 32 million euros.
They're just carrying on expanding their asset management business at hopefully a reasonable price, because they didn't give any details what, as far as I saw, I didn't see assets under management or profitability numbers or anything like that. I didn't see it.
It manages around 1.3 billion euros of private client funds.
They give it, but private client funds is actually quite a good business to get into. But it's
this is the second deal of this kind for Investec.
Oh no, they've had plenty of these deals going back over the years. They're just expanding their highly successful London-based asset management company.
Is this the time to do so, though, Wayne?
Probably not a bad time to do it. I mean, financial services, and I work for financial services. Financial services has gone ex-growth. They've had the glory years. We've had the glory years. The glory years were the debt-induced bubble in hedge funds, or whatever you want to call it, where every second, those days are gone. We'll see them. The next generation will see that again. You won't see it again in our generation. Doesn't mean you shouldn't work for financial services. It doesn't mean you can't make money. But the glory days are gone. So I don't think they're going to be overpaying in this environment.
So Tiger Brands also up into today's session, up 1.6.
Look, Tigers did so well the whole of last year. It's done extremely well. But you've got to sit and say now, what about the valuations? Where the valuations not exactly on Tiger's side now. I mean, it's a good, solid, wonderful company. The valuations aren't on your side here anymore. There's possibly...
And this actually goes for all, not only the food producer space, but also retailers and all, anything.
It's the whole story of cyclical versus non-cyclical. The resources got pounded last year. The retailers did well. We might see the reverse this year.
So just a bit of rotation coming through there. We're seeing Exxaro up 0.7%. Kumba, we had production numbers out of Kumba yesterday. That's also up into today's session. And I mean, it's basically very mixed picture
There's
today.
not much happening today. No shares have really moved. Okay, Mondi's at the bottom of the top 40. That's down 2%. But there's no massive movements of any one particular sector, except that the financials have gone up. The banks have gone up quite nicely in relation to the overall market going down.
So the big question is, do you buy construction stocks now?
Man,
Group 5, that trading statements, 42%, as much as 42%
But the market knows this. I mean, don't think the market thinks construction isn't going up there. The market knows there's trouble out there. And, you know, if you follow all the classic investment theory, you know, the old-fashioned platitudes of buy when everyone else is selling and buy when there's blood in the streets.
But it hasn't been a crowded place since last year.
Yeah. All of these good things tell you that you should be looking at the building and construction sector, because there is value there. We are still going to build things. I mean, don't for a moment think shares are cheap when there's good news around. Shares are never cheap when there's good news. Shares are cheap when there's bad news around. So you as an investor got to decide. You got to answer two questions. Number one, is it going to disappear? Is it like it's not going to disappear? So then the question is, do I buy this year or next year? Then it's just a question of when do you buy, because the shares could still fall some more.
It could fall some more, or if there's an anticipation of a much better environment, then they start pricing in the future. Yeah. And even though they
look, for what it's worth, and we've got no more information than anyone else has got, and it's our guess versus anyone else's guess, we're actually buying now. Could be wrong. I mean, who knows?
Are you buying Group 5?
Not Group 5, you're buying building and construction shares.
Are you buying as a whole?
General package, you're buying PPC, you're buying Stefaniti stocks, buying some Wilson Bailey, etc., etc. We're not putting all of our eggs in one basket. We're not investing our whole portfolio into this.
Worse off than the other, though, Wayne? Is one worse off than the
other?
No,
they all operate in the same environment. Some are just in slightly different areas, and some are just possibly better managed than others, and they've got stronger balance sheets. In fact, it's actually more of a balance sheet argument than a management strength or a company strength argument. It's a balance sheet issue.
Let's touch on Lewis revenue for the 9 months. Rose 7.1%.
Yeah, it's not great, but the furniture sector we know hasn't actually been doing all that well.
Yeah.
But in this environment, there's a lot of cash around here. The cash retailers, the cash non-furniture or non-durables are actually doing quite well in this environment. But we own some Lewis and we're keeping it. It's still to us reasonable value.
Oh, what other retail stocks do you own at this stage?
Got Pick n Pay. We overweight Pick n Pay. We believe in the recovery story. Only time will tell whether we're right or not. So we got that. We got a bit of Spar. We got a little bit of Shoprite, but heavily underweight Shoprite. We got a bit of JD Group. We've got quite a bit of Woolies. We've got Clicks. That's what we are.
With regards to MTN, it's been a very big story that hit the market this week with regards to Run. It's been ongoing. MTN operates in that region. What do you do with your MTN shares?
Look, is it a good company? Yes. Has it got an incredibly strong balance sheet? Yes. Will its business be decimated if something goes wrong in Nigeria or Iran? I doubt it. So it's just a question of, do I buy at the current level or do I wait for 10% lower? Look, to me, it's not an inevitable outcome that the Straits of Hormuz will be closed or that there'll be a total and utter unmitigated disaster in Iran. I don't think that's an inevitable outcome. I actually think this will be resolved because quite frankly, no one wants trouble. I mean, that is just the honest answer. No one wants trouble. We've seen what's happened with other hotspots in the world. No one's got the appetite for trouble at the moment. So I think this will be resolved. The Nigerian story with the petrol that's all been resolved. So that's almost off the table. Look, there's still a few north versus south and a couple of little incidences there, but that's not a major thing. I think this whole Middle East story, specifically related to Iran, will actually be sorted. So we're holding on to our MTN shares now. We're not buying any more, but we have got a very big position, and we're holding it.